Good morning, and thank you for joining us for our BDC update, part of KBRA's private credit webinar series. While all attendees have joined in listen-only mode, we encourage you to engage with our speakers through the Q&A feature on your control panel. Thank you to those who submitted questions in advance, as we'll be responding to those throughout the webinar. Additional research regarding this topic, as well as our rating reports, can be found on our website free of charge at kbra.com. If you haven't already, please scan the QR code on your screen to create a username and password on the login page to access all of our content. Should you have any additional questions on the topic, we would always be available for a follow-up call. Now I'd like to hand things over to our esteemed speakers for introductions.
Thank you, Caitlin, and welcome to KBRA's latest BDC webinar. I'm Joe Scott. I head up the financial institutions team at KBRA, and currently we rate over 300 financial institutions, including notably 30 BDCs. Also, BDCs are an important part of KBRA's extensive coverage of the private credit space. Our coverage encompasses funds, asset managers, private credit CLOs, numerous other rated transactions, as well as a sizable database of underlying middle market companies. And with me today is Terry Seelig, who many of you already know. Terry leads our coverage of the BDC sector. In addition, we have Kevin Kent, who focuses on BDC coverage as well. Terry's going to share her views of the first quarter results of the BDC's trends in credit quality, other key topics. And then we're going to turn it over to Kevin, and he'll provide findings related to an upcoming research report that we're putting out in the next week or two on BDC loan valuations, which has been very topical recently. So Terry, first to you, how's the first quarter shaping up for the BDC sector?
Thanks, Joe. So first quarter earnings have been coming in over the last 2 weeks, and we're seeing very solid net interest and investment income. BDCs are definitely continuing to benefit from the high base rates and good spreads. In last year and the year before, deals were being underwritten as high as 650 over base rates. So really good earnings. And also a lot of debt was issued in the low rates of 20 and 2021. So BDCs have been basically top of their game. Earnings continue to be strong. But that's not the case today as far as ongoing. There's been a lot of spread compression recently from competition. As we know that there's been a lot of capital raised, a lot of formation of new BDCs and credit platforms. So the BSL market is back. So going forward, we do see some tightening, and there will be spread compression. We've seen it as much as 150 basis points. There's also been some fee pressures. Volumes are low due to the dearth of transactions in M&A, IPO. So we do think, though, that earnings are solid, but we do see some headwinds from rate compression and competition. One thing, though, we are hearing from BDCs is they will concess on price, but not credit quality, which is good for us to hear.
Okay, thanks, Terry. And then with rates expected to be higher for longer, talk about credit quality and how credit quality is holding up for the portfolio companies of the BDCs.
Sure, yeah. Everybody has been thinking about, we've been higher for longer than we had expected. But the portfolios are surprisingly are holding up. We still see non-accruals very low. And in this quarter, we're seeing maybe one additional non-accrual, added to last quarter, which was also net, we're seeing some reductions in non-accruals in first quarter. So for our KBRA rated universe, we're still under 1%. But we do have a number of BDCs that are newly established, so unseasoned portfolios. So we went back and we looked at the top 10 BDCs that have been operating for at least 4 years to look at what those non-accruals would look like at cost, and they're still under 2%. So that's not materially changed year over year, and it still indicates a benign credit environment. So we feel positive about the credit environment right now, cautiously optimistic, because we would have thought by now we would see more cracks in the portfolio. But one of the other leading indicators that we feel and we've been focused on is also looking at BDC internal credit ratings. And so we're looking at what percentage of the portfolio is performing, at or above underwriting expectations. And that's north of 90%, which we think is strong. And that also has not material changed year over year, just slightly. So we believe that, the BDCs continue. They've been underwriting defensively in less cyclical industries. And, perhaps that is the strength of the quality of the portfolio right now. There's been very little energy underwritten, travel, leisure, consumer loans. And so the non-accruals have been low. We do see, though, portfolio company interest coverage has declined, but that's expected with rates going from 0 to 500 basis points. But we hear that the private equity firms are working with these portfolio companies to reduce costs. We have been told that revenues have continued to increase, but at a much lower rate. So they're able to sustain fixed cost coverage. And the other thing I should note is that BDCs, the loans are sponsor backed. So they've got strong private equity sponsors, and LTVs have been less than 50%. So there's pretty much a solid cushion. Also, private equity firms have a lot of dry powder, so they could, if they needed, to support these portfolio companies. So we do see value in sponsored back deals. A lot of questions have been coming up on the question of PIK. We don't see a material increase in PIK, and we've looked at it even this quarter over quarter. It's pretty stable. I think that PIK is difficult to gather information from the filings, in that a lot of the deals have been originated with PIK. So as far as PIK being an indicator of troubled loans, it's a lot more difficult to discern. But we don't believe, looking quarter over quarter or even looking at last year, that this is a problem at this time. We are hearing, though, that more deals are being originated today just due to the competition, maybe with some PIK involved, just to give more flexibility to portfolio companies for liquidity.
Hey, thanks, Terry. And then we've seen a lot of senior unsecured debt issuance this year, and then also in the fourth quarter of last year by the BDCs, and what's really behind that increase?
Yeah, so Joe, we're really looking, we've been really focused on the liquidity of BDCs. It's of utmost importance that there's sufficient liquidity, especially should markets become disrupted. And it's been a really strong market for the sector to issue debt. So we've seen the BDCs have been issuing, over the last 6 months to pre-fund 2024 maturities, which we feel is a good indicator of strong market presence, and they've been able to pay down their revolvers and issuing this unsecured debt. So when we're looking at the BDCs, we're looking at the 2-year liquidity to ensure that they're able to fund their upcoming maturities, because there is a wall in 2024, 2025. And our rated universe has really strong liquidity. So we feel very good about that. From a credit perspective, the unsecured debt in the capital structure is always great because it offers a lot of financial flexibility and unencumbered assets for the note holders. So from a industry perspective, they've been able to tap the capital markets quite successfully. We've rated close to $4 billion of debt already in the past 4 months. And that's due to the strong earnings of the BDCs, their benign credit environment, low leverage. So the BDCs look really strong from a credit perspective, our universe. So they have been successfully tapping this market.
And then beyond senior unsecured debt issues, what other avenues have BDCs taken to diversify funding and to ensure sufficient liquidity?
Yeah, so what's happening in the markets, because the BDCs have grown so much and there's been so much capital raised in the BDCs, that they need to look outside for increased investors, right, to finance BDC balance sheets. So there's been a lot of issuance of or more issuance of CLOs and some SPV rated asset facilities, which opens up an increased investor base. So we think that that's been an important, although it's secured, we feel like that is an important funding source. And so when we're looking at the BDCs, we're also looking at the funding mix, where they have access, whether it be the bank revolver credits, unsecured, CLOs, SPV asset facilities, just to ensure that they do have access to capital.
And now on to Kevin and his upcoming research piece on BDC loan valuations. And Kevin, what sparked interest in conducting this research and writing this paper on BDC asset valuations?
Yeah, we've seen a number of occasions where commentators on the private credit space in the media have publicly questioned the reliability of BDC valuations, specifically valuations of level 3 assets, which constitute usually at least 95% of a BDC's assets. Level 3 assets are essentially illiquid assets with little or no market activity that would help establish a fair value. These commentators have cited, a number of instances where valuations of the exact same investment in unrelated BDCs have been materially different. So that's what sparked our interest in researching the issue. We wanted to determine whether or not BDC valuations are robust and well considered and consistently approached analytically, and therefore useful for analytical purposes. It's also important to note that valuing level 3 assets is fundamentally an exercise in estimating values for a buy and hold strategy. So the fact that the assets are slated to be held to maturity reduces a lot of the apparent risk, because much of the valuation marks are a result of current market information, such as interest rate spreads, rather than credit degradation. So that doesn't tell us much about the likelihood of receiving timely and full interest and principal payments.
And what was the approach taken to address this valuation issue?
Yeah, we interviewed representatives from 2 of the big 4 valuation firms to understand how they interact with BDC management and how they approach the valuation process. At KBRA, as you mentioned, we cover about 30 BDCs. So we looked back at our notes to flesh out some further detail about the internal approach toward valuation and how BDCs use third-party valuation reports in their processes.
And then tell us what you found, Kevin.
Yeah, so a critical takeaway is that is that each BDC, via its board of directors, is ultimately responsible for the final valuation that's publicly disclosed. We found that BDCs have similar, though unique, approaches to determining valuation. A typical BDC will have an internal review process with a valuation committee, an audit committee, and with ultimate board approval. BDCs collect portfolio company documents such as monthly and quarterly financials, and they employ internal valuation models. At the same time, BDCs hire third-party valuation firms to provide independent assessments, which can range from, valuing each position each quarter to each position rotated at least annually. The third-party valuation models and the internal BDC valuation models employ proprietary approaches to valuation, but we found similar patterns to valuing level 3 assets. The valuation models require that a portfolio company's enterprise value be estimated to determine current LTV or leverage. The common approaches for valuing cash flow companies are multiple of EBITDA and discounted cash flow. Though the approach is generally flexible based on individualized circumstances and access to reasonable projections. Valuation also requires looking at technical information such as current credit spreads and other market conditions. These numbers, along with leverage, will help to establish the fair value of a loan asset. And then usually a third party will provide a range of valuations to its BDC client, and the BDCs each have their own approaches to reconcile a final valuation. Some, for example, have a policy to just take the midpoint of the ranges, while others might have a policy that uses their own internal valuations, so long as it falls, within a range provided by the third party, and so on.
And what did you conclude about the whole valuation process?
Yeah, we found the valuation processes, both internally and externally, to be robust, and we found that the analytical approaches are reasonably consistent.
Yeah, and I also understand that you sampled the BDC universe to address the specific concern regarding different valuations of an identical investment by unrelated BDCs. Share the findings there.
Yeah, to that point, we sampled a significant portion of the population of overlapping investments between between unrelated BDCs, same portfolio company, same maturity date, same spread. And to clarify, the BDCs were from completely unrelated investment platforms. We looked at senior secured first lien debt, which covers a strong majority of investment in the BDC universe. And we also looked at senior secured second lien debt. In both cases, we only looked at overlapping investments that had a fair value of at least $10 million to ensure materiality. For senior secured first lien debt, we sampled about 37% of the overlapping population of the BDC universe that fit the criteria I just mentioned. That equates to 100 samples. For this sampling, we found that the median difference between the highest percent par valuation and the lowest percent par valuation was right at 1%. Because there was such a tight range, we can infer that unrelated investment platforms with identical investments are independently approaching valuations and generally drawing approximately the same conclusion, though there were a handful of outliers. So comparably tight ranges were also found for senior secured second lien debt. This second lien debt comprises a much smaller proportion of BDC investments, so we were able to review essentially the entire population of around 40 overlapping investments with at least $10 million of fair value. In this instance, we found a tight range as well. The median difference between the highest percent par valuation and the lowest percent par valuation was just 1.7%. We expected this to be a moderately wider spread because senior secured second lien debt is riskier. Distressed second lien debt can have wider bands of valuation because it requires analyzing various scenarios for principal recovery on more uncertain collateral. And this was consistent with our data set, which indicated that a substantial portion of outliers, about 40%, were distressed.
Thanks, Kevin. And what's your overall conclusion?
Our conclusion is that there is minimal variance among BDCs in their independent valuations of identical assets, despite some isolated examples, which indicates a rather consistent analytical approach to valuations across the industry. If there's if there's interest in how BDCs approach valuing level 3 assets, I highly recommend giving the special report a read.
Yeah, absolutely. Definitely worth a read. And thank you, Terry. Thank you, Kevin. Now on to some questions. And we'll start with Terry. Please describe the competitive environment for deal investment or origination and returns. I think we touched on this a bit earlier, but also due to the increased interest in the private credit market by asset managers, including those that were originally focused on the private equity space, but diversifying across private credit and then also other competitive forces.
Sure. So yeah, as I mentioned, before is that there's been a lot of interest in the private credit space just because of the strong returns. So there's been a lot of capital, a lot of new formation of funds and BDCs. And at the same time, we've had a dearth of deals just because of, slow transaction volume. So there are two things for competitive pressures. One, you've got a lot of capital chasing very few deals. So in that regard, spreads have definitely tightened quite a bit, as much as 150 basis points we're hearing. So last year, spreads were 600, 650 over, and today, more like 500 or 550. And so this is really more problematic at the higher end. So this is the upper middle market of 100 million plus, because, that is the BSL market as well. So you've got new capital formation, you've got the re-entrance of the BSL market, some banks, and then you also have a dearth of deals. So there will be more spread compression in the deals that are being done today. The deals from last year and the year prior were quite high in the spreads. And also, as I had mentioned, those were being financed at very low rates from 2020 to 21. From our perspective, though, it rests in credit quality, and some of the BDCs are willing to take price concessions, but not credit quality. We are hearing, though, also that BDCs are maintaining strict documentation requirements, especially in the middle market BDC portfolio companies. So we're happy to hear that as well.
Yeah, and I know we touched on PIK features earlier, but how does KBRA incorporate PIK into their ratings for BDCs, and any concerns at the moment regarding PIK trends?
Yeah, so we're definitely looking at the percentage of PIK over investment income. And, quarter over quarter, we haven't seen any material increase, and year over year, slight increase. But as I mentioned, a lot of the deals, especially on the technology and software, are being originated with PIK, with initial PIK so at underwriting, and is not necessarily an indication of a problem loan. So it's more to give the portfolio companies more liquidity for growth. So we haven't seen anything material as far as any increases, but we're definitely keeping our eye on it.
Yeah, without a doubt, we're monitoring it very carefully. And then just another question on an overview of stress testing, modeling for downgrade risk, and then touch on private credit risk analytics. I know default trends in the past 5 years have been very benign, very low, but maybe talk about the expectations for the rest of 2024.
Sure. So, the BDCs have their watch lists, and usually those are credits that are internally rated, or three, it depends on the BDC. They all have their own definitions, but there are loans that are performing below expectations at underwriting, and they're given much more attention to make sure that they get ahead of any credit problems. And so those are being tested, the variables depending on the sector of the portfolio company. But I think, whereas last year they were stressing a higher rate environment, I think, BDCs are thinking that just maybe higher for longer. So keeping base rates at the rates that they are now and stressing out, how long the liquidity for the portfolio company. And then working with the private equity firms in ensuring that there is coverage.
Yeah, and then we'll touch some more on leverage. Here's a question on BDC leverage, which has been kept relatively low so far this cycle. But can the BDCs continue to maintain the leverage discipline, or will they lose patience and break too soon, especially given some spread compression, and maybe that gives you the incentive to lever up a bit more?
Right. So leverage is low. I think ours universe is at maybe 1 times. It's probably going to come in the, in the first quarter. So that's extremely low. I think that's an indication of the discipline of the BDCs, that if the deals are not up to their standards, that they're just not underwriting. So, and also, as I had mentioned, that their transaction volume overall is quite low. For the perpetuals that have raised a lot of capital, they are investing in more liquid assets such as the BSLs, which could be a temporary investment until the market opens up. We're hearing that, the expectations of second half of more transaction volume, but that's, yet to be seen. But what we're hearing is that the disciplined approach to maintaining high credit quality standards that have, maintained very strong, solid credit amongst our BDCs will continue.
Yeah, we just had another question come in. This is more on the valuation front, and then good to get Kevin's thoughts, but also Terry, if you'd like to chime in on this one. And it regards valuation of internet companies. These are companies that are not likely to be profitable anytime soon in certain cases, but have significant subscription revenue growth. How do you see the approach to valuation in those cases?
Right. So we do have a number of BDCs that do have, we call them like recurring revenue loans that have negative EBITDA. They're more valued on a revenue basis. So, and they're usually a small part of a BDC's portfolio, but unlike a BDC's being measured by EBITDA, they are measured by revenue and revenue growth. So these are the loans that I'm talking about that have PIK in front of them. They're usually originated at PIK, and then they revert to cash paying in 2 to 3 years. So while we've seen very strong growth in prior periods, especially in the software, the growth has come in somewhat, but they continue to grow. So, we're hearing that they're not a lot of concern, and we've looked at those loans to see if they're in the internally rated, problem loans, and it just doesn't seem to be the case.
Yeah, it seems like in the vast majority of cases, they're performing in line or perhaps even better than prior expectations.
Yeah, I would say that. And the BDCs in general have a small portion of their portfolios in recurring revenue, so not a concern.
Yeah, and then another question just came in on understanding that the vast majority or most BDC loans are held to maturity. Have you looked at any of the BDC's loan assets and sales of the assets versus most recent valuation?
Yeah, I mean, we ask actually the BDCs themselves. So, because it would be difficult for us to track unless they go into non-accrual because they are held to maturities and BDCs are not trading the assets. But where it comes in is when we're having our conversations with the BDCs, saying you marked it to X, where did you get out at? And you can see, from quarter to quarter, what's happening with, the non-accrual basically valuations and where they're actually exited. But that takes time and could take even years. So, but it's an interesting question and it's definitely something that we have addressed in our meetings, but it's been very few, right? Assets that have been actually sold that we can be able to track.
Yeah, it's typically a held to maturity business model. But at the same time, sometimes you get refinancing, especially with the syndicated loan market coming back. Sometimes the BDCs will get refinanced out, but that would be typically a performing loan getting refinanced at par. So I think this is a question we really look at in the asset manager space, especially for private equity focused asset managers, where we look at what the realization value was on a private equity portfolio company versus the last quarter's valuation. So that's very important as we analyze these private equity focused managers. Because that's part of their strategy, part of their business model to ultimately realize these assets at a gain. So that's an important consideration when we look at the many private equity focused managers that we do rate. And generally speaking, the valuations have been conservative there.
Yeah, like you said, the BDCs are holding it to maturity. They're not really tradable assets. And also, when a BDC is underwriting, it's really for yield, not for capital appreciation. So there's a big difference in the underlying strategy.
Yeah, I don't currently see any additional questions. Wait, one just came in. So here we go. How does BDC leverage look like against their NAV under management? I think the question is looking at BDC leverage against the NAV of the BDC rather than EBITDA. Is there a lot of price tiering among BDCs? I'm not sure if that's on the debt side. Maybe we could address the price tiering of BDCs on the debt side. We've seen a lot of debt issues. I don't know if you have any thoughts on that.
I'm not sure I completely understand the question. You're talking about the issuing of debt and where it's getting priced at of the
Well, I'm not
BDCs?
sure if this price tiering question refers to the equity of BDCs or if it's debt. We could just assume it's probably debt issues and how debt's being priced between one BDC versus another. Do you
Well,
see a lot of differences or do investors more view it as a generic asset class where there's not a lot of difference in the pricing of the bonds?
yeah, I mean, BDCs are, like I mentioned, are kind of top of their game right now. So they've had a lot of access to the capital markets because we believe that, the BDCs are, have solid liquidity, low leverage, strong earnings, benign credit environment. There is, there are differences in spreads, due to, different ratings, right? We rate from triple B plus to triple B minus. So there is. But one thing is that the spreads are tighter this year, I think, than last year. And they're doing so there's a lot of access to the market. I don't know if that answered the question, but
Yeah, and then I think the first part of the question versus NAV, I think that's more an equity question where a lot of the equity investors will look at the market value of the equity versus the NAV of the BDCs. I think the vast majority of the rated ones, the larger BDCs are close to their NAV in terms of market cap.
yeah, it's been a very strong year for the BDCs once again. And we've seen most of the BDCs trading close to par, close to NAV, which wasn't always the case. You know, a year or so ago, they were trading at much larger discounts. And that has definitely narrowed with a large percentage of the BDCs now trading at or above NAV.
And then we have another one from an anonymous attendee. It's a view on smaller borrowers and performance of smaller borrowers versus larger borrowers. And I think that's really tough to generalize. And at the same time, you have to look at how the BDCs are pricing for risk. I know some of the BDCs that focus on the lower end of the middle market have more pricing latitude and pricing more for higher risk, whether it's real or not. And there's been a lot more competitive pressure, as Terry has said, in the upper middle market currently. So any general views on small borrowers versus large borrowers? I think it's really too broad a topic.
Yeah, I think KBRA's analysis in our private credit group has come, you know, basically been saying that they haven't seen a big difference in lower EBITDA portfolio companies versus the higher. So, you know, time will tell, you know, where this plays out, but we don't really have historical data right now to make those conclusions.
Yeah, the situation, as everybody knows, has been so benign for many years that it's tough to come up with a lot of hard data. We're just starting to see a small uptick in non-accruing loans, problematic loans, very episodic. So really tough to generalize on that one. And then we have another one on what distinguishes the leading BDCs from the rest. Is it their underwriting criteria, risk management, scale of activities? Another anonymous question.
Yeah, I mean, we rate only the top BDCs, but obviously there is a, you know, a wide variance in total assets. So, but you know, I think it's a case by case basis on the BDCs, and it's not necessarily that the BDCs that have the largest investment portfolios have any different type of criteria versus the smaller BDCs with, let's say, $1 to $5 billion of assets. So, you know, ours are rated appropriately for the risk that they take. So, don't see a big difference within our universe.
Yeah, but the ones that we've rate versus the many smaller BDCs, the vast majority we rate are part of very large credit platforms.
Yeah,
They
we
have the
do. Yeah.
resources of the credit platform, the analytical resources, the infrastructure, the monitoring resources. And then generally they're dealing with high quality sponsors. So on the private equity side, the leading BDCs are generally dealing with your top tier private equity firms, which have quite a bit of dry powder and tremendous resources on top of the BDC resources. So those are some of the reasons why we feel comfortable with many of our rated names in this uncertain environment.
Oh, for sure. We definitely believe that scale in this market is a huge benefit. And I would say the majority of our rated universe are affiliated with large platforms. So as you mentioned, Joe, there's a lot of derived benefits from being part of an overall large like asset manager or credit platform, without a doubt. And we're thinking that it's becoming more and more important in this competitive environment, for sourcing, research, uh, whether it be workouts or just SEC exemptive relief where they're able to take down larger deal sizes. So definitely in this market, we view it as a positive.
Yeah, then there's another question on PIC. It's the topic of the day. But anyway, with the borrowers having the PIC loans at origination, does this imply the BDC lender is assuming growth in the company's EBITDA? And we partially addressed this, or is it factoring in Fed rate cuts?
Yeah, it would be a combination, but I think that these are solid companies that are, revenue billion or dollars plus, and they're looking at revenue growth that will eventually become EBITDA positive, regardless of rates. That's how I'm thinking that that's what they're looking at. So these are strong companies that have, solid customer base, are growing at a speed at which they need the liquidity to finance that growth. And at some point, hopefully in the next 2 to 3 years, will turn EBITDA positive, regardless of where rates are.
Yeah, and I think primarily focus on less cyclical sectors as well, which Fed rate cuts always are nice, but at the same time, I think it's being underwritten more on the premise that you give them flexibility for growth.
Mhm.
And then there's another one here on given benign conditions, what are your top concerns for the BDCs over the next 12 months?
Mm. Yeah, I mean, we're continuing to look at, credit quality, because higher for longer, I don't believe that we anticipated this, a year ago, although we did think that we would see more non-accruals. So we think that credit quality is solid right now. But that's an area that we're continuing to look at, because it's, how long can these portfolio companies withstand a higher rate? So that's why we're kind of focused on interest coverage. And as I mentioned before, the BDCs are trying to get ahead of it, working with the portfolio companies to ensure that there is coverage. So whether it be growing revenues, reducing expenses, that's all ongoing. So there's a lot of activity within that talk between the BDCs, private equity firms, and the portfolio companies.
Yeah, it looks like we have one more question on, and it's regarding how widely do KBRA's ratings vary versus your peers?
Yeah, so we do rate, our ratings are from right now we have ratings on BBB plus to BBB minus. So relative to our peers, we have more varied and bespoke ratings because they're in different classifications.
Yeah, in our belief, it's very valuable to investors to try to differentiate among the BDCs. And we think in some cases there's clear differences. So, and then we put in the rationale behind it as well. So I think that's about it on the question front. I don't see any other ones coming in. So I'd like to thank Terry and Kevin for their insights today. And then, of course, thank everyone for attending today. And then be on the lookout for our upcoming research report on BDC asset valuations. And then just to remind everyone, each quarter we publish a BDC compendium, and we'll have our first quarter compendium out in the next few weeks that focuses on key topics of the sector and provides updates and individual updates of each of our publicly rated BDCs. We have a number of privately rated BDCs, but all the public rated BDCs. In addition, I think just to add, our corporate team recently published the inaugural Middle Market Borrower Surveillance Compendium, which I think is definitely worth a read. It's a very top-notch publication. So look out for that on the KBRA website. And with that, we conclude our latest BDC webinar. Thanks again.